Good morning, everyone. Well, yesterday was a mixed day in which it was hard to discern a consistent trend. European leaders joined U.S. President Obama in warning Russia that it would face further sanctions if it failed to de-escalate the crisis in the Ukraine. That seemed to cause general risk aversion. Stocks were lower, U.S. bond yields fell sharply, and the yen gained. Fed funds expectations retreated nearly 5 basis points on the long end, suggesting that some of the tightening concerns generated by the recent FOMC meeting are fading. Finally, the auction of U.S. Treasury 5-year notes came at a level through the market and saw the lowest dealer takedown in history. That indicates a significant end investor demand for the bonds. This is all good, the usual risk-off signs. But at the same time, gold fell again despite lower interest rates, and the commodity currencies were the biggest gainers among the G10. Plus, most of the emerging market currencies gained against the dollar. So those are hardly risk-off trades. It's all rather confusing to me, and to be honest, I don't have a good explanation for these two divergent trends. The euro weakened as next week's inflation report and ECB meeting are starting to weigh on the common currency. It may be that the various comments by a string of officials about the strength of the currency are starting to have an impact on the market. I still expect the ECB to loosen policy further sometime this year in order to deal with low inflation and the strong currency, but probably not at next week's meeting. As for today, the Nordea Bank decides on its deposit rate. While the market expects no change in interest rates, the focus will be on the press conference after the decision and any statements about when the bank will be ready to increase rates. After the last meeting, the krona fell on the bank's dovish statement that it was not considering a rate hike until the fourth quarter of 2015. The Eurozone M3 money supply for February is coming out today. The 3-month moving average is expected to be unchanged at 1.2% year on year, which is not very exciting, even by the standards of this not very exciting indicator. I think the more important point will be whether the slowdown in the pace of decline of lending and credit creation that we saw in January continues. That would be a modestly good sign. In the UK, the Bank of England publishes the statement from its March 19th Financial Policy Committee meeting. At the same time, UK retail sales, excluding autos, are out. They're forecast to have risen 0.3% month on month in February, a turnaround from a fall in January. That would be positive for sterling. From the U.S., fourth quarter GDP is expected to be revised up on the third estimate. The initial jobless claims are expected to be a bit higher, but the 4-week moving average should fall, and pending home sales are forecast to have accelerated in February. All in all, this would be solid news that should give the dollar a boost. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, Global Head of FX Strategy at IronFX Global, wishing you solid trading.